As thematic investors, we start our work by being students of our sectors. We really aim to live in the nuance of those sectors, and we try to resist the tide of momentum that can lead us to different understanding or a more nuanced understanding of the themes that we're pursuing than what might be suggested by the common wisdom or the flavor of the month. And that divergence, the divergence between common wisdom and what a patient student of the sector comes up with as the areas in which we want to focus, can create opportunities that we find attractive, but that others in the market may not be pursuing. It starts at a very high level. It starts by focusing on the drivers of the individual themes in the spaces that we study. Let's start, for example, by looking at generational wealth and trying to understand the trends in wealth relative to the several recent investments that we've made in and around the wealth management space. If you look at the headlines and you think about the conventional wisdom around the future of wealth, there's a lot of attention. Most of the popular attention, in fact, is focused on two major themes. The first is this tidal wave of wealth that will transfer hands in the coming years, especially from baby boomers to millennials and Gen Z. The baby boomers are rapidly retiring. In fact, in 2025, we reached peak 65. And what that means is this is the year in which more Americans are reaching retirement age than have ever before or ever likely will again. 4.2 million people in total are reaching age 65. The second general popular view is, it's a little bit more comparative in nature. It's that the millennials are in a sad state financially relative to the generations that preceded them. Again, this is a chorus that you hear across popular media. It's really quite deafening in terms of the number of folks who bemoan the future of the millennials' financial position and ultimate retirement. The common belief is that baby boomers reaching retirement age are really the last generation where it can be taken for granted that they would be better off than the generations that came before them. So both of these common themes reflect some things that are true, some important truths, in fact, with respect to major trends in wealth, but both also dramatically oversimplify the more nuanced reality of personal wealth and the trends that will shape the wealth management industry in the decades to come. We've spent a lot of time trying to get our hands around the more nuanced understanding around this space. It's informed very much the investments we've made in and around wealth management. What we think is much more interesting than the common wisdom is that the wealth millennials and Gen Z will make for themselves is one of the primary reasons we're so enthusiastic about wealth management. Millennials are beginning to enter their peak earnings years, and Gen Z is just starting to ramp. And because these generations have a higher propensity to invest in financial assets such as equities, their wealth is both compounding faster and actually represents a greater opportunity for the wealth management industry than some of the generations before them. To put some numbers behind that, over the next 10 years, these generations are on track to generate over $30 trillion of investable wealth on their own, which is actually much more than they're going to inherit over that period, and over 1.5 times the amount of investable assets baby boomers created over the last 10 years. If you look at the 10 years beyond that, because of the power of compounding and the higher allocation that these generations dedicate to equities, they're expected to generate another $110 trillion. So because of the choices that we see millennials and Gen Z making, and this is quite different than the popular wisdom about those generations, we're actually very confident that the multi-decade long trend of American wealth creation will continue to accelerate. And we've built a portfolio we think is really well positioned not only to benefit from that trend, but to support thoughtful wealth management for those two generations. So this includes companies that benefit from increased demand for holistic wealth solutions, like, for example, Creative Planning and HB Wealth, growing allocations to alternative assets, which is a favorite area for these generations. That includes investments like Cliffwater, and the continued rise in 401k savings plans. And companies like Human Interest are very well positioned to benefit from that. One area in which there's a gap between common wisdom and the metrics and the measurements that we find really important relates to lifespan. As a society, really as a species, we've always been focused on living longer. With continued advances in healthcare, recent headlines suggest the possibility of routinely living to 100 years or even 150 years. It's very understandable as to why people are focused on lifespan. When you look historically, medical science has made extraordinary gains in expanding lifespan over the past 200 years. We've more than doubled the number of years we expect to live since 1850. Largely by decreasing childhood mortality. If we take a look at the much shorter time frame, over the past 30 years, the average lifespan has continued to increase. It's actually increased by about 2 years over the past 30 years. But if you look closer, the average years spent in good health during that same 30-year period have actually declined. In fact, it turns out that all of the gains in lifespan were driven by more years in poor health, slightly more than 100% of the overall gains. So while we're living longer, we're actually less healthy for those extended years. So that brings us to the importance of not just focusing on the metric that is most readily measurable, lifespan. For us, we also think it's important to focus on health span. That's the average number of years that someone spends in good health. Not just increasing lifespan, but increasing health span. This informs very much how we invest in healthcare. If you think about, as an example, oncology therapeutics, which account for nearly 40% of all late-stage pharma assets, it's a pretty good example, particularly if you look historically at the difference between lifespan and health span. If you go back to 2014, a study that was conducted found that among 70 approved oncology drugs, the average increase in overall survival rate was just 2 months. And further, those incremental months were often spent experiencing a range of side effects. 2/3 of patients using oncology therapeutics reported 6 or more side effects. And given the high cost, survival side effects, and relatively modest survival gains, it's a fair question to consider as to whether the oncology treatments of the mid-2010s and prior decades were singularly focused on extending lifespan, and whether they excluded other important objectives and metrics like health span. Now, recent breakthroughs in oncology vaccines, as an example, and leveraging the immune power of the body through immunotherapy to fight cancer, are all dramatically transforming how cancer is being fought, and certainly creating much more opportunity for step function breakthrough changes in how cancer is treated. Today, there are 6 approved cancer vaccines to prevent cancer, another 300 candidates in the pipeline. State-of-the-art therapies represent a totally different universe of innovation. The biopharma industry is focused on preventative breakthroughs rather than very expensive small steps towards longevity. And this is an area we're spending a lot of time in our life sciences investing. Across the healthcare sector, we believe we're bringing a more nuanced approach to improving health span, improving the patient experience, the cost efficiency, and lifespan in all the areas in which we invest. Artificial intelligence. Today, if you look objectively at the metrics over the past few years, the only reasonable conclusion is that for all the focus, for all the intensity and occasionally hype around AI, almost everyone still underestimated the first-order effects of AI. AI native companies are scaling revenue far faster than any previous business model. OpenAI and Anthropic have scaled to $100 million of revenue in less than 2 years, and more recent AI startups like Lovable are scaling even faster to $100 million, now measured in months rather than years. On the infrastructure side, the Mag 7 doubled their annual CapEx spend in a mere 2 years to over $320 billion in 2025. These numbers are hard to fathom, but to put that in context, major tech giants have already invested more in the AI boom in just 3 years than the US spent on the entire interstate highway complex, a project that took 4 decades to complete and represents the largest infrastructure project in the history of the United States. And there's a war for AI talent, the likes of which we've never seen before. We all know athletes, LeBron, Max Verstappen, Steph Curry. They've received eye-watering annual contracts, north of $50 million per year. But the mathletes are now king, with AI researchers commanding massive annual contracts, often orders of magnitude higher than even the highest paid sports superstars. And at TPG, we are investing both behind AI directly and through AI-empowered plays like, for example, Lyric in the healthcare space. Our experience in the space spans about a decade, with early investments in companies like C3 AI, which is one of the grandfathers of modern AI. Through our Rise Fund, we've partnered with Google on Intersect Power. We've invested in Miratech, both of which are indexed to growth in data centers, and we've recently announced a major partnership with Tata Consultancy Services to rapidly scale India's data center infrastructure as well. We've developed deep expertise. If you have a good enough arm, you can hit most of the leading AI companies with a rock from our San Francisco offices, and that certainly helps. In short, we have a lot of resources focused on AI. But while a simple look at the metrics of AI growth might support a thesis that AI would disrupt everything in a uniform way, in a sort of Pac-Man eats everything sort of way, we've tried to dig a layer deeper and think through the second-order impacts. In reality, tech disruption may not be the tsunami that destroys everything in its path. And in several situations, we've seen incumbents effectively adopt that new technology to their benefit. You can see this across our portfolio at TPG. We're investing in the first-order impacts of AI, and we're also focused on opportunities tied to second-order effects, which are often much more subtle and overlooked. These include areas in which the desire for human connectivity and services have only deepened, human for longer, where tech fatigue will likely increase demand for impactful in-person experiences, where incumbents can effectively harness AI to improve their business models. One of our benefits in the context of AI is that we have a tremendous number of resources focused on understanding AI, but we also have literally decades-long focus on the sectors like healthcare, like climate, software, business services. We've studied those sectors, we're students of those sectors, and we're able to marry an understanding of AI with an understanding of how the real world works in these sectors. That allows us to develop a much more nuanced view as to how AI will affect the businesses and the themes that we're pursuing, and where we might want to pursue a more disruptive theme or a more disruptive company, or where we feel the incumbents will leverage AI to their benefit. And again, it's that combination, it's that marriage that allows us to develop unique insights as it relates to AI and how to think about that in the context of the work that we do as investors.